Let's go live to our business editor, Ross Greenwood, who is in Sydney. Ross, talk us through expectations here.
So what we know around the world, Tom, is already inflation is rising significantly off the back of fuel prices, housing prices, but then also the shortage of supply is also pushing many prices much higher. So annual inflation is expected to come in from the markets at 3.2%. We'll find out the actual number very shortly. In fact, it's just dropped 3.5%, so significantly higher than what the markets had forecast, and again increases pressure potentially on the Reserve Bank to raise interest rates. At some stage in the future. Remember that their determination is to keep interest rates relatively low, close to zero, until potentially the end of next year. And the question now is, with them meeting just next week, whether that's going to change their attitudes in regards to this inflation number dropping today.
Yes, so for those inflation watchers, of course, 3.5% year on year. The inflation target, remember, is 2 to 3%.
Yes.
So how straightforward is it? Because the other thing we've got is right now we're in a quarter that's going to be heavily affected by Omicron, Ross, and that might lead a bit of a holding of fire on the Reserve Bank. What's your view on that?
Well, that's true. So you've got the consumer price index for this last quarter, which goes to the end of December, up by 1.3%. Now, as we go down further into this chart, what we're going to see is some of the things that were rising fastest, not during that quarter, but also over the year. There's one of them. Petrol is right there. So the cost of transport in the past 12 months was up by some 12.5%, which is probably the biggest contributing factor. And so the Reserve Bank, to a certain extent, looks through this. So it looks down to what's known as the trimmed mean. But the interesting side about this is that the annual trim mean now sits at 2.6%. So in other words, the Reserve Bank's preferred measure of inflation is sitting even higher than forecast. It was around 2.5%, the forecast, 2.6%, and it's going to the upper end. Remember, the trim mean it likes to have sitting between 2 and 3%. So in this particular situation, that trim mean is perhaps the canary in the coal mine here in regards to interest rates and the attitude of the Reserve Bank, which simply long term, you'd imagine, like other central banks around the world, cannot continue to ignore the rising prices, and that its own measure of inflation is now getting to the highest points. But as I say, we'll know a little bit more when the Reserve Bank meets next week.
Right, so that's the important element. That trimmed mean they look at is going up, albeit it's a lot lower than the overall figure that's spat out. What about the crucial element, of course, and how this will feed into the RBA's decision? Well, wages. We've heard Philip Lowe talk about this, that this is still his, the big one for him.
Well, it is. And remember that, you imagine that full employment for the Reserve Bank now certainly has a 4 in front of it, and perhaps even has a 3 in front of it. We know that there are labour shortages. We know that labour shortages cause pressures for wages to rise. If wages rise, then prices rise. One of the interesting parts about this is that companies now, for the first time in more than a decade, have almost got an ability to raise prices. Consumers are understanding it. But that also leads to greater wages pressures. Doesn't matter whether it's a national wage case or whether it's indeed enterprise bargaining agreements when they come up. There is going to be more pressure as a result of rising cost of living for those wages to rise. So all of these things end up being almost like a vicious cycle. And the one thing you do know is if all of a sudden there's any hint that this inflation is out of any economic control. The Reserve Bank has always said Australia's different to other countries. We've got an ability to bring labour into our country, open the borders, all that type of thing. Well, it hasn't happened to the extent which the Reserve Bank would have liked. And as a result, it's said in the past that we somehow are different to the rest of the world, which is why it's maintained its attitude that interest rates will remain low. I just have a suspicion that maybe even this number today, which is crucially important, is going to be something that could potentially just change the attitude, not just of economists, but maybe many of those inside the Reserve Bank as well.
So is that, just very briefly, Ross, is that your tip, that this will ultimately mean likely an interest rate increase in the next few months?
It's not necessarily coming in the next few months, but certainly by the end of this year, these pressures continue to build. They don't have any reason why they should go away anytime soon. Now, the supply chain shortages right now around the world are also adding to this. So shortages of chicken, of other forms of meat, are really contributing to what's taking place. The fact that there are a lot of goods locked on docks right now, not able to be got out, that is adding to the price supply pressures. So all of this is simply, if you like, an ongoing narrative, and it's not as though any of this is necessarily going to change anytime soon, and that can be borne out by even US inflation. The headline figure there at 7%, well above 5% in the UK and in Germany. So this is not something that is unique just to Australia. It's taking place even bigger in other parts of the world.
Ross Greenwood, live analysis straight off the back of those figures, so coming in higher than expected. We'll continue to analyse that through the day and see what that might mean for interest rates, as you heard there.